So, good morning. I'm Leonardo McClarty. I'm the president of the Howard County Chamber of Commerce, and it is my pleasure to have with us today the president of the Federal Reserve Bank of Richmond. And I'm going to ask, actually, I'm going to go through and mute the lines of everyone as I'm getting background noise here. And so I'm certainly going to ask each of you if you would do it on your end in the event that if I don't get to you first. But certainly thank all of you for taking time out of your schedules to join us for this conversation on the nation's economy, as well as how it's impacting all of us. And certainly, I think we have a great speaker in Tom that's lined up to share his insights, as well as to take questions from the group. Our agenda is very brief, and that again, Tom is the feature. But I do want to acknowledge and recognize the Chamber's 2020 annual partners, and so thus you see them on currently with the screen share. And again, really just want to acknowledge and thank them for their support, as truly it has been sorely needed this year. And without them, not sure exactly what state the chamber would be in right now. As for those of you that have followed, we've been ineligible for a few of the federal programs. And so thank you to our annual partners for their support this year. And with that, it's my pleasure to turn things over to one of our annual partners right now, who is going to actually introduce our morning speaker. And that is Apple Ford has been a great partner of the Chamber for a number of years that even predates my tenure here, which is now going on 6 years. And so we'll hear from Chip Deutsch from Apple Ford, who's going to bring a few remarks and then introduce Tom Barkin, our speaker. Chip.
Thanks, Leonardo, and good morning, everybody. First of all, Leonardo, thank you to you and your staff for putting together valuable information in the midst of a little bit uncertain time. Certainly need all the input to make decisions that we can gather. I've recently had some direct experience with Tom, and I would say that he and his staff have been gathering grassroots information, kind of looking forward instead of looking at historical data to support some of the decisions being made. That said, it's my pleasure to introduce the smartest guy in the room. Tom Barkin is the president and CEO of the Richmond Fed. He joined the Richmond Fed in January 2018. In his role, he's responsible for the bank's monetary policy, bank supervision and regulation, and payment services, as well as the oversight of the Federal Reserve System Information Tech Organization. Tom served as a voting member in 2018 on the Fed's chief monetary policy body, the Fed Open Market Committee. Prior to joining the Fed, Tom was a senior partner and CFO at McKinsey & Company, worldwide management consulting firm. And he oversaw their offices in the southern U.S. He also served on the board of directors for the Federal Reserve Bank of Atlanta from 2009 to 2014 and was the board's chairman from 2013 to 2014. Tom is a member of Emory University Board of Trustees and the Greater Washington Partnership. He received 3 degrees from Harvard, his bachelor's, master's, and law degree. And with that, Tom, I know everybody's anticipating hearing your commentary about some of the information you've gathered. Thank you for being with us this morning, and it's a pleasure to introduce you.
Thanks, Chip, and thanks for the time you've given us. As Chip says, we do spend a lot of time trying to understand what's happening on the ground, and at times like this, when the data is basically obsolete, it's really helpful to hear from people who are in the economy live. And so, one of my aspirations, while I'm sort of metaphorically here in Howard County, is to share a little about what we're seeing, but another one is to hear from you what you're seeing. So we'll have plenty of time at the end for questions, but also plenty of time for comments. And so if you guys have perspectives on what you're seeing in the economy, certainly in our role, trying to understand things that are happening in our district, we're all ears. If it's okay with you, I might talk about 3 topics. First, a little bit about the state of the economy. Second, just an overview overview of some of the efforts being made by us and others to improve it. And third, some reflections on the possible path forward. These are all my thoughts, not necessarily those of the Federal Reserve System or the Federal Open Market Committee. And that then frees me up to answer any questions you have as directly as I can. So I'm looking forward to that. So let me start with the state of the economy, which you know isn't good. Our efforts to control a health crisis through social distancing are having staggering effects on multiple segments of our economy. You all know it started with a shutdown of large parts of physical retail and restaurants and travel and tourism and arts and entertainment. Just for perspective, 70% of the US economy is services. 30 million people work in just those sectors alone. And so those folks have been really hard hit. But the rest of the economy has been hit hard as well. Automotive demand has plunged. We saw some numbers yesterday on that. Airline struggles have affected aerospace. $20 oil is decimating the drilling and exploration sectors. Business closures are damaging landlords. The meat supply chain is threatened. Even hospitals are facing a revenue crunch as they're foregoing elective surgery. And as I talk to folks in our district, cash flow and liquidity are issues everywhere. You might have seen last week, first quarter GDP reported at negative 4.8%. That's the first drop in over a decade, and consumer spending and business investment were each down around 8%. But as I said earlier, those numbers are obsolete. The second quarter is going to be much, much worse than that, perhaps somewhere in the range of plus or minus 30% down. And the global numbers should be every bit as bad. To dimensionalize it a bit, we do get some numbers that are more real time. We get initial unemployment claims weekly. For the last couple of years, they've averaged down about 200,000 a month. In the last 5 weeks, 28 million Americans have filed for unemployment. That's 17% of the workforce. Consumer sentiment we get every other week. That's plunged at an unprecedented rate. And if you look at some other real-time indicators, TSA throughput in the airports is down around 95%. Hotel revenue is down around 80%. Credit card spending, depending on the segment, is down around 20 to 30%. So, real impact, and you just hear a lot of emotion from folks in those industries who are suffering so that the health of others won't. So that's the state of the economy. As I said, it's not good. Given the profound implications on the economy and society, you see work in 3 lanes to try to bridge to a post-COVID world. Just to remind you, the last crisis was financial, and so the Fed was the natural lead. This is a public health crisis. And so while the Fed can support, I'd say we're at best or the third chair here behind public health authorities and the fiscal authorities. So I'll talk about each of those and then talk a bit about the Fed. Public health is obviously the most critical. Widespread shutdowns have been an effort to ensure hospitals have capacity, and that seems to be working. But states are still very much in the midst of landing reopening plans that balance limiting the breadth of recurrence with getting the economy moving again. And that's hard to do absent a treatment or a vaccine. Second is fiscal. And just a reminder, what's happened to date has been really significant and important, but it's stabilization. It's not fiscal stimulus. You see things like unemployment insurance expansion, payments to low to moderate income individuals to bridge them, a small business loan program, the PPP, funding to endangered industries like the airlines. These are all good concepts, but I do think the downturn is likely to last longer than just a couple of months. So to the extent that these concepts are a bridge to the other side, we need to plan for what more is needed if the valley is wider than we thought. Third, I want to talk about monetary policy. And the Fed, given our independence, we had the ability, I think, to move the fastest. We took rates to zero. We gave strong guidance to banks that they should continue to lend to good credits in need, and that we would adjust unnecessary regulatory constraints. I might note this is a tricky task, as we also at the same time want to make sure the banks preserve their soundness. Third, we made significant interventions to try to backstop markets. We started by ensuring the Treasury and the mortgage-backed markets continue to function. And then with the Treasury backstop, we had the ability to support the commercial paper markets, the asset-backed security markets, and the money market funds. And then finally, this CARES Act legislation put almost $450 billion in place to backstop lending programs. And we've announced several. We've announced a program for new and secondary market investment grade credits. We've announced a lending facility to take PPP paper effectively off bank balance sheets. We've announced a short-term municipal tax anticipation facility. And then finally, a Main Street lending facility, which would make 4-year loans with the first-year payments deferred to medium-sized businesses. As Chair Powell has said, and I just want to emphasize, these are lending programs, not spending programs. People get confused about that. And they're focused on supporting good credits through their time of need. So I've talked about the state of the economy, and I've talked about some of the programs. Where do we go from here? In my mind, the core challenge is to get to the other side of this with a healthy population and a functioning economy. And I do think as we begin to emerge from this lockdown in most states, that means we need to be working on two things. First, the economy's recovery rate, and second, its landing point. So first, on the recovery rate, I do believe we're going to be able to return to something like normal operations, though it will be gradual. The experience of China and our essential industries gives me confidence this is doable, so long as we have widespread adoption of proven protocols like structural distancing, cleaning procedures, temperature testing, gloves, masks, and the like. But I think the harder part is going to be a return to consumer confidence and spending. This episode's been a real shock. Maybe a treatment or a vaccine will appear, but if not, infection risk is going to remain as consumers consider returning to the economy. And that means that businesses that require personal interaction are going to need to rethink their protocols. They need a story that'll convince consumers it's okay to shop or to travel or to go to a restaurant again. It's like the TSA post 9/11. It was messy, but 3 months later, you could convince yourself that it was safe to fly. I see supermarkets doing some good things today. At least at my supermarket, I'm greeted with somebody with a mask disinfecting the cart. The aisles are one way, and there's tape on the floors so that you can keep an appropriate social distance in the checkout line. The cashiers have sneeze guards. All these things send a message to consumers that you can shop without putting your family at risk. I will say that I think the recovery rate will be slow. I look, for example, at China and Korea, who closed down earlier than we did and reopened earlier than we did. Even 3 months later, retail traffic in China and South Korea is still 40% down from last year. Or as I put it in a thing I did last week, we took the elevator down, but we're going to have to take the stairs back up. So I've talked about recovery rate, but I also worry about our landing spot. In other words, how high can we go here? And think of the potential of our economy as the size of the workforce multiplied by the productivity of the workforce. And in the aftermath of this crisis, both factors are threatened. Our response to this virus is closed schools and daycares, while also threatening traditional forms of elder care. And I talked to a number of dual career couples and single parents or care providers who face daunting challenges in balancing work and home responsibilities. Without much more support, many risk leaving the workforce. Perhaps we'll see vulnerable populations like baby boomers protect their health by retreating from the labor force too. We've displaced in this pandemic a large number of waiters and retail clerks and the like, and they may struggle to move into new careers. And pandemic control efforts are already making immigration even more difficult. In an environment where demographics was already shrinking our complement of workers, these changes could accelerate its decline. Productivity could be challenged too. A new set of health and distancing protocols in restaurants, retail, and manufacturing operations will likely reduce throughput. Real estate assets are being stranded. Businesses are already redesigning their previously optimized supply chains to focus on resiliency at the expense of efficiency. More fundamentally, with increased debt loads, reduced bank lending capacity, and diminished confidence, that has to have a meaningful impact on investment levels, through which most productivity enhancements funded. Now, there's still much we can do to make sure we don't end up on the other side with a smaller, lower productivity workforce. As states plan to restart the economy, they do need to make care industries a priority to support workforce participation. Job retraining needs to be a focus too. One bright spot of the current shutdown has been the investment made in online educational delivery. I'm hopeful states will find they can deploy online retraining to the broad swath of the unemployed, perhaps even at a very low cost. And finally, in the spirit of never wasting a crisis, we need to motivate business investment and new productivity levers. I'm reminded airline kiosk adoption really only took off after 9/11. Perhaps retail self-checkout, food delivery, telehealth, and even online education will see similar adoption escalation, as will surely online shopping. Perhaps new productivity investments will need some government incentive to bring confidence back in an uncertain environment. So to close, it's notoriously hard to be optimistic when you're in the depths of the crisis as we are now. But I'm a big believer in American science and its ability to create a vaccine and a treatment in time. I'm also a big believer in the creative capacity of American workers and businesses. They need to reimagine their businesses to help consumers regain their confidence, while the rest of us provide the health, fiscal, and monetary support necessary to bridge them. So Leonardo, that's what I had prepared. I'm more than happy to take questions, comments, and as I said at the beginning, any input on what folks are saying real time.
Okay, excellent. Well, what I want to ask everyone to do, if there is a question, if you would just place it in the chat line. You can either do it privately to me, and I'll certainly be following it. I'm also going to first start off with a couple of questions that we had sent to us prior to today. And this first one pertains to mortgage rates. And the question is, why are mortgage rates not necessarily keeping pace with the reduction in the Fed rates?
Yeah, so we took Fed rates to zero, as I said. And one of the things we noticed immediately is that some of the mortgage markets, the mortgage-backed securities, were not trading the way they normally do. Spreads versus risk-free rates were elevated. And that's one of the reasons we've gone back and started purchasing so many mortgage-backed securities. I think you had a time of dislocation. I think you had prepayments happening as people refinance, and just happening at a scale that the markets weren't ready to handle. And so that's one place we've intervened. You also hear, as I've been in the market, some people in the market, mortgage servicers are the most active, I think, talking about challenges they've had in this forbearance environment with their economics. And so I sense there's some set of a lack of demand of mortgage assets in the mortgage market as people try to work through those issues. So certainly my hope is that we'll get mortgage spreads back to traditional levels soon. It's already starting to move that way. But I just think you're seeing dislocation in markets and dislocation by players that are preventing that happening at the pace that I would like.
Excellent. So the next question that I have was, and I'm just going to read it as it was presented. And so it says, I understand that on March 23rd, the Fed announced the purchase of corporate bonds. And certainly this person is applauding that program. And they were told that this includes junk bonds and, quote, fallen angels. And if so, is there a purchase cap on the program? How long will this last? And do you see any long-term effects when you unwind this program?
Well, so we have announced a couple of different programs on corporate bonds. The first, which was done at the very beginning, was to resurrect a commercial paper facility that we used back in the last crisis, and that very much focused on investment grade paper. That's been up and running now for well over a month. The second, which is being finalized and launched, relatively close to now, is a corporate bond facility, and I think that's the one you're referring to. We have said that's focused on investment grade paper, but we've said investment grade defined as a date in March, and so there will be some fallen angels that will be able to have their bonds purchased in that market. We've also said there'd be a targeted amount of that that would go into high yield ETFs. We wouldn't be buying individual junk bonds, but we would be buying some high yield ETFs. And both of those are efforts to stabilize those markets. In other words, you've got the Fed in the market, helps those markets work a lot better. There is a cap on those funds. Just a reminder, the Fed's not allowed under our charter to lose money. And so all of these are funded by backstops from Treasury. And so, if you will, Treasury is setting the credit standard in the buy box on those, and they are capped against the equity we've got. Now, to the extent that we find that particular facilities are having the right kind of impact at scale, we do still have backstop available to expand those facilities if needed. But for now, they are explicitly capped. And I don't have the number in front of me, but it's easily available on the website.
Okay, excellent. So we're going to shift to a couple of international related questions now. And so this first one is, so the Fed has extended swap lines to many countries, yet some notable nations like Turkey are struggling. Any discussion of broadening the circle of nations for which the Fed accepts currency swaps, or is that group complete?
Well, we've got two programs underway. One is another resurrection of an '08 program, which is specific swap lines with specific countries. What we've done with those countries is we've swapped with those who I'd say have the highest level of credit standards and relationships with our country, and so you can feel like you're in a situation of mutual trust. That covers, I think it's 8 or 10 countries. That doesn't cover all the countries. And so what we announced 2 or 3 weeks ago, it's called the FIMA, is basically a repo facility with folks who have kept treasuries with us. And so that allows us into a bunch more countries. I can't remember, honestly, if Turkey is one of them or not. But all those things are collateralized by the treasuries which we hold. And so that's a second version of it. None of these, to be clear, are funding to Turkey or funding to any other country. That's not the intent of them. It's just to help make markets function in the right way. And so, that's how we think about both the structure of those programs and which countries are allowed in.
And speaking again on the international side, if you could speak a little bit regarding your view on the dollar and how it's moving relative to other currencies and the retrenchment of capital flows.
We focus very much on our economy. We don't focus on dollar or relative currency. And so I can't claim to be particularly current on the specifics of all of the interaction. It does occur to me that the major things that affect the dollar include the health of our economy and rates in our economy compared to the health of other economies and the rates in those economies. And I think the entire world is going through a similar situation. The entire world is struggling with this virus. The entire world is struggling with businesses being shut down. And the entire world has taken rates about as low as they can go for their particular countries. And so, I see a lot of commonality here. And I think the future path will depend on the future strengths of those economies. And I think that will depend, critically on how successful those countries are on their public health situation.
Okay. So we're next going to, I guess, go back into workforce development area. And particularly just in terms of, what industries do you perhaps anticipate being growth areas ultimately, I guess, as the economy recovers, as we look at some of our retraining programs and so forth? Any industries, perhaps, I guess, that you would see coming back sooner than others?
Well, we're definitely seeing real differences in performance by industry. If you were at a Walmart or a grocery store chain, if you were in an online shopping arena, you'd be particularly pleased with the amount of business that's coming in. And obviously, if you're in a restaurant or physical retail, you wouldn't. So you'll see some amount of movement, I'd say, that sort of accelerated things that were already underway, like the move from physical to online shopping. Perhaps you could also say that'd be true for food delivery. Perhaps you could also say that'd be true for telehealth. I'd say then separately, there are a set of industries that already were short people, and now I think are going to be increasingly short people. Think of home healthcare for a second. If you have an aged parent who really needed help, maybe you'd be a little more nervous about which nursing home to place that parent in. Perhaps on the margin, you might spend the extra money and get someone into your home as opposed to having your parent go somewhere else. So I think that was already an industry that was tight finding people, and that's another one. I think it's going to be even tighter going forward. To go from there, then you have to make I think you really have to speculate on where we're going to land from a public health situation. I'm not one of those people who thinks that, oh my God, the entire world has now changed for good and we're never going to, have personal interaction again. On the other hand, you have to be open to the possibility that we're going to be operating lots of businesses with different distancing protocols. And again, that depends on how comfortable Americans begin to feel with the risk of infection and also the severity of infection. But if you did believe that you're going to have things be a lot different, you could imagine real moves, let's say from mass transit back to automobiles or other individualized forms of transportation. You could imagine, an even more pronounced move out of some of the industries that have mass gatherings, think concerts and tickets and shows and symphonies, and the like, cruise lines. But I think all of that is deeply dependent on what assumption you make about where we land as a country in terms of our public health protocols. And I think it's just way too early to make any of those calls. I don't envy the people in those businesses trying to survive as they think about those.
Yeah. Excellent. Well, we're going to now talk, I guess, what's been certainly a popular topic, and that is real estate and lending and acquisition and so forth. And so this question pertains to for the real estate acquisition. And so for those businesses that do have reserves, is now the time to actually make real estate acquisitions? Are the banks looking favorably at commercial lending, particularly from a real estate perspective?
I should have said beforehand, if you're coming to me for investment advice, you're coming to the wrong person. So I'm not gonna do any of that, and I'm certainly not going to speak for the banks in terms of what they might or might not be willing to finance. I think again, it's hard to speculate on what the future is going to be from a public health situation, but I think of real estate very much in different segments. So retail real estate. I think that's going to be a challenged segment. I think physical retail, it's going to take a while to come back. There are longer term trends in place anyway. So some of the big box retailers, you've already seen bankruptcies in apparel stores and others over the last couple of weeks, and others threatened. So I think there probably will be a pretty significant oversupply in that segment, and I would guess it'll take a while for that to come back. On the other hand, if you talked about residential real estate, I think actually residential had a very strong first quarter. I think there will probably be some period of time during which houses are going to struggle to sell, because if you can't walk through a house safely, you may not do it. But at least my forecast is there's a real business there. Supply is short in residential real estate, and I think residential will continue to be a healthy market. Not least of which is because rates are low, and that will also help that market. Industrial is a segment where you've got warehouses and online and all that. And if you're in the right segment of industrial, that actually feels like a growth segment. And then I think most unclear is probably office. Some people will make the case that working from home is going to be the future. I'm not quite there yet. I hope you're enjoying this view of my library. But I don't. I've got my adult kids back home, and we're having a good time. But I've talked to lots of people who actually are having a real trouble getting work done. With schools closed and little kids, and they're just dying to get back to work. Now, I think it's likely to change. If you believe that continuing health protocols are going to be the answer, I'm sure bullpens are going to be structured in different ways. I'm sure the long-term trend towards space efficiency might have some issues. So I don't know how we're going to think about tall elevator banks and spacing people in elevators versus climbing upstairs. So I think there are going to be some shifts in office, but I think it's way too early to tell. And so that's a little bit about the demand for it. And of course, those people who are thinking about investing in real estate always have to look at the price. And again, I don't have a particular opinion on that.
Yeah. And so next, I guess, while we're still kind of talk about, I guess, lending and so forth, certainly PPP and idle loans and so forth has gotten a lot of our attention and so forth, in particular from small businesses, whether they've been able to access them or not access them. But I think at the same time, if I'm correct, the Federal Reserve, I think the Main Street program, I thought may have been one of yours or what have you. But I guess maybe if you could speak a little bit as to how do the Federal Reserve programs, I guess, either tie in or support those that you may apply for from a traditional lender? And I guess when would perhaps also a small business go to you versus going to one of the traditional, lenders that are in the marketplace?
Yeah, so maybe just first for context, this isn't a perfect diagram, but I think of it as three different segments of loans that were set up by Congress in the CARES Act. There's the PPP, which is focused and intended to be small businesses, less than 500 employees. There's Main Street Lending, which is intended to be, call it 500, whatever, 10 or 15,000 employees. And then there's the corporate bond program that I talked about earlier, which is intended to be for corporations that have access to the public markets. Okay. The third one I've already talked about. Think of it as people who've got bonds in the markets, bond ratings, and the like. And again, that's not a forgivable loan program. That's just a market liquidity program for those who are investment grade. The PPP you know about, but just a reminder, it's a Small Business Administration program. It's not a Fed program. It's a Treasury small business program. And those are forgivable loans if one keeps payroll at certain levels. And so, those are very attractive to the extent you qualify, because a forgivable loan, looks a lot like a grant once it's forgiven. The Main Street program is the one that we're administering. Again, we were directed to do this by Congress. It's a loan, not a forgivable loan. And so it's a interest in principal deferred loan, but it's still very much a loan. And it is focused on people with, and there's a bunch of criteria I won't bore you with, but certain coverage ratios, there's certain conflict disclosures that need to be made. And importantly, they're not being made independently. They're being made by banks. And then, the Fed is taking, depending on which lane you go into, 85 to 95% of the principal onto our book. And so I still think if you're a person who needs that kind of credit, the place to go is a bank. They'll make the first instinct. And the question of whether the bank decides to hold that loan on their books, or if you will, to syndicate that loan onto the Fed books, will depend on whether the structure of the loan fits your thinking. I'll just say for perspective, it's not like we have a bunch of bank lenders out running around trying to make loans. It's actually really helpful to us to have access to experienced underwriters in the banking system. And then we've structured a set of loans that the banks can make that we'd be willing to hold, and we'll see what the demand for those are. We're getting a lot of comments now, and we are trying to tailor the design of those in ways that do enhance the demand. But of course, we'll see what happens when they hit the market, and if need be, we'll adjust appropriately.
Okay, excellent. And so on that same note, and this is just for some of our small business owners out there, I guess any particular advice that you might share with them, particularly if they've been either, I think, one, unable to obtain any of the additional, I guess, of the stimulus, PPP loans, or idle, or what have you. So that's maybe the first question. And do you think that ultimately the COVID-19 pandemic, do you think it's going to change lending in terms of how it's done, whether that's requirements or as we look at credit and so forth, particularly from a lending perspective, and how our institutions are looking at our small businesses when they're looking at extending credit or them taking on debt?
So I do think I've talked to now a lot of businesses who have applied for and received the PPP funding, and I do have the sense that there is a real reward in the process to being on top of the process, being on top of the numbers, being on top of the filings. And so getting the right accountant or lawyer or whatever professional helping you do it feels to me like it does have a return for those folks. So first point is, if you can be eligible, those loans are designed for you. If you're not eligible, then I think there is very much a business decision. I don't see it so much as a bank lending decision. The banks historically have certain segments that they do loan to and like lending to, and certain segments that they don't. They have a responsibility to make good loans to credits you could pay back. I'm not sure I see that significant of a change. This is very much a temporary program. But I do think if you can't get those loans, it does have real implications for cash flow management and even how one might morph their business design in the future. As I said in my little talk, I think it's important to assume you've got some amount of continued resistance to personal interaction while people try to maintain their health. And so rethinking and redesigning a business to be cash flow positive while also being, I'll call it healthcare positive, is an important thing. And it's certainly something I spend a lot of time thinking about.
Okay. So we've had two of these monstrous stimulus packages to come through, and so yet we still have an economy that is still struggling, and a number again of small businesses that are trying to figure things out. I guess maybe a two-part question. The first is kind of what, maybe as you look at your crystal ball, what do you foresee? I guess, is there another stimulus package to come, and if so, perhaps what does it look like? As it's shaped and molded in light of the first two.
So maybe a better way for me to answer that is to say, at the time that these first stimulus packages were passed, and again, I like to refer to them as stabilization packages because it's pretty hard to stimulate a bunch of folks who are sadly out of their jobs. I think the assumption was that we would have what many people call a V recovery. We would go down fast. I said we would take the elevator down and then we would take the elevator back up. And so I do worry things like the PPP program, which are 8-week programs, which will expire, I think, 5 weeks from now, whether the amount of business that our small businesses will have 5 weeks from now is going to be sufficient to have made the bridge from where they were to where they're going. And so I do see a different kind of recovery. I think will be down for longer than just the check mark that's implied with the V. And I think the return risks being less high than the top of the V. I don't want to get cute, but maybe you'd call that a reverse J, where you go down and then up a little, but not all the way back up to the U. And so I do think our legislators are going to need to think about what the priorities are going to be in that world. It would be useful to the economy to have additional funds put in there in the right way, in the right form. And I think our legislatures now have a little bit more time than they had the first time to try to design things to hit exactly the problem we're going to have. And so we know we're going to have unemployed people for longer than we thought we're going to be. That'll be one question that needs to be addressed. I think we are going to have small businesses in these sectors struggling to come back to where they were. I think that's another issue we could choose to address. I do think you've got issues of knock-on impacts. And one of the things I've noticed as I talk to folks is that the government has thrown money behind certain programs to help certain sectors, but there are lots of other sectors who have their hand up saying, wait a second, I'm also getting hit. And so there'll be real choices that they'll have to make about, do they put funding into other places? State and local governments is one you read a lot about, but you could say the same for hotels or nursing homes or daycare, as I was suggesting. So there are a lot of places that I think we're going to need to think about those. And then, as I suggest, as we get business started again, things that stimulate spending, things that stimulate investment are also really productive places to go. Our consumers may well need just an extra push to get out and engage in the economy again, and that'll be worth thinking about. So they've got a lot of work to do. I wouldn't presume to comment, but there's definitely going to be a lot of needs out there.
And I guess on that latter piece, when you talk about consumers needing that push, I guess perhaps what are some of those things that might lead itself to a push, or that might perhaps lend itself to some type of consumer confidence or what have you, just either based upon what you've seen elsewhere or just looking back in terms of other previous economic challenges or what have you?
Well, so it's easy to go to, taxes and spending programs, think a sales tax holiday or whatever. But, I come back to public health being in the first chair here. And I actually think the biggest stimulus of all would be real clarity and consistency and unanimity among public officials saying that if you do these 7 things, don't worry about it, you'll be safe. Because I think at its core, the challenge we have is the challenge of, keeping one's family safe. And so I think about even in my life, how do I go have a meeting with a contact, go to an FOMC meeting? How am I going to do these things and then go home and tell my family, don't worry, we haven't taken any risk? And so I think if whoever, the public health officials in a state or nationally could align behind, if you do these 5 things, we're really convinced you're safe, I think that would be the greatest stimulus of all. I would note, most estimates would say that disposable income in the second quarter is actually going to be up, not down. The combination of all these payments, and so there's a lot of stimulus out there. The issue isn't money, and the issue is people's willingness to spend. And so I think some sort of protocols that we all had confidence in, and I referred to 9/11 in my speech. Whether you agreed with the TSA or not, in January of 2002, you could convince yourself that flying was not, putting your life at risk. And I think we need enough health protocols to tell ourselves that, shopping is not putting our families at risk.
Excellent. And so looking at, again, job growth and job creation and so forth. And so just as we look at the future of public policy, ultimately, I guess, where do you believe small businesses perhaps, may want to place its legislative emphasis? And this is a question that's coming from our attendants here, from our attendees, I should say, in terms of ultimately just, where should we, from a small business perspective, really try to emphasize our legislative efforts to really try to support small business?
Yeah, again, I'm not probably the best person to talk about legislative priorities, but I really think that what small businesses need is consumers confident to shop or to eat in a hotel or to do whatever. And so I come back to public health, and whether that's testing kits or temperature checking or those kind of things, or whether it's standard protocols, common things. I'm empathetic. I know there's been talk about liability protection, if you open your business, but things that allow people to shop in ways that create confidence. I'm intrigued with, I've talked to folks about business interruption insurance, which doesn't cover pandemics. And, just like this terrorism insurance, is there a role for a public insurance backstop? Things that allow you to operate at full speed again, that's really what we're getting at. I think about that much more valuable than I'll call it cash flow bridging, because again, I think the valley here is wider than we thought. And my worry is that it ends up being so wide you can't construct a bridge over it. Mm-hmm. And so I'd much rather find ways to narrow the valley, to raise the other end of the river. And I think those have to do with giving people confidence they can shop, travel, eat out, those sorts of things.
Yeah. I think it was certainly something you mentioned earlier on the public health side of it as it relates to, as we go back and if we look at 2008, 2007, that period where, again, it was more economic and this being public health. And I think because we do have this public health challenge, that's what continues to put all of the, I guess, the monkey wrenches in terms of trying to forecast and analyze, because maybe particularly on a weekly basis, we may have some type of new public policy directive which changes either when we can open, how we serve. And that's constantly, has, I would say, speaking even not so much business, but I'll say employers constantly juggling where do they go next and so forth. So certainly I think that's will be a big key as we move forward. And hopefully with the creativity of business people, there will be opportunities that they will find in the midst of, I guess, this COVID-19 challenge to come up with new strategies to try to address some of those things. For our participants, we're getting to the nearing the end of our conversation. We certainly want to make sure that we continue to get your questions answered. And so if there are any additional questions that you have, certainly feel free to put them in the chat line and on the private side, or you can, again, post it publicly. We are recording this, and so certainly that way we'll have all of these, the answers that are given, provided to you at a later date. But I guess as we prepare to maybe wrap up, I guess, Tom, what I guess, I guess this was Sports Center. I say, what are your parting shots? What perhaps, or maybe just a few things you'd like to end on or convey as we kind of look ahead and look to the future.
Well, the first thing I'd say is I really miss Sports Center, and maybe I share that with everybody else here. But that's certainly the lack of daily sports information has been a struggle for me.
Well, at least you have your own SVP there, and so if you ever want to see a shaved head, all you got to do is look to your Baltimore office.
Andy Bauer, I think you just got called out. No, I just say this is a public health crisis, but this public health crisis, we have finished the phase of taking the elevator down. I do think over the next month, in most states in this country, we will have finished the next phase, which is starting to reopen the economy. I don't believe that where we go from here is set in stone. I actually think there are lots of things we can do to influence where it goes from here. And so this notion of how do we get the recovery rate steep enough that it helps our businesses come back to life? And how do we make sure that we don't inadvertently damage the economy in the interim? Those are things I'm very much focused on. And I think back to something you said about, which I also said, which is businesses are creative. I'm really encouraged by the states that are laying out the frameworks for phase 1 and phase 2 and phase 3, because when they do that, they give businesses clarity. And I really think if you tell somebody what the rules are going to be, and here's what the environment's going to be, and here's what the timing's going to be, people can make thoughtful and good decisions about calling people back or not calling people back. I think the real challenge is the uncertainty and not knowing whether you're going to be closed for another week or another month or another 3 months. So I think all of that is very important. And then I'll just say, the faster we can get ourselves aligned on a set of protocols and a set of treatments, the healthier it's going to be for the economy. And so as I talk to health officials, that's where I certainly focus my efforts.
And so this is one question, and I'm glad this person in the chat line actually asked this question, because it reminded me, I had it on the top of my mind to ask it as well. And that is, and maybe this will be our last one as we wrap up, and that is ultimately with the trillions of dollars that are being provided for and all of the various stimulus packages, ultimately, where's the money coming from, and what is this going to have the U.S. look like in the future, particularly as we talk about ultimately paying it back?
Yeah, so where it's going to come from is easy. We're borrowing it. You may have noticed the Treasury announced $3 trillion in borrowing in the second quarter yesterday or the day before. Debt as a percent of GDP in 2007 was in the high 30s. Debt as a percent of GDP 2 months ago was in the high 70s. Debt as a percent of GDP by the end of this year, I think, is already scheduled Congressional Budget Office to go over 100%. Now, we've been over 100% before at the end of World War II. There are other countries. Japan is, I think, almost at 200%. I'm not saying that's the aspiration, but I am saying it doesn't have to hit you immediately. But at some point, we have a set of creditors, and those set of creditors either are comfortable with that debt load or are going to demand a higher interest rate for that debt load. As a character in The Sun Also Rises, Hemingway, when asked how he went bankrupt, he said gradually and then suddenly. And I think that's how it happens, gradually then suddenly. I want to emphasize
I actually believe we need to make the investments in the economy that we're making right now. So to me, this isn't a question of what we're doing today. This is a question of a long-term trajectory. And in the long-term trajectory, I believe we're going to have to get our fiscal situation under more control. Whatever combination of less spending, higher revenues, or increased growth does that. So we have to do what we're doing now, but I do think on the other side of it, there's going to be a need for real conversations about how do we land it in the right place.
Excellent, excellent. And so with that, we're going to get ready to wrap up and close things out. And so one, I want to thank Tom for sharing with us this morning. Also want to just acknowledge and thank your team as well, who has been great to work with over these past couple of weeks or so, and trying to get this organized and scheduled and making sure that we were all the technology was working correctly and so forth. So again, thank you. And so just a couple of other comments that I want to share with the group before we conclude things today. So again, I want to recognize our annual partners for 2020 and thank them again for their support. You see them on your screen here. Also want to encourage you to continue to check out our daily newsletters. A couple of upcoming events that we have, particularly when we were talking about small business policy. So next week, actually on the 13th, we're going to have a small business town hall forum with Congressman John Sarbanes. And so that's going to be on the 13th from 1 o'clock to 2 o'clock. You can certainly go to the Chamber's website to register for that. As space will be limited. But again, we're going to have a conversation with Congressman Sarbanes. Certainly he and I have spoken, and he wants to particularly hear from small business in terms of obviously challenges, opportunities, expectations, even from your congressional team and so forth. So again, that's on the 13th. The other thing that also we're starting to pull together that will be starting very soon as well is something that we're calling Preparing to Open. And it's going to be basically a 5-part series where we're going to touch on a number of issues and things that we just need to be thinking about and be aware of as our offices and businesses and things prepare to open, and I guess in a more traditional, even if it is a non-traditional sense. And so we're going to talk about things such as facilities or offices or places of work. We're going to talk about education. We're going to talk about childcare. We're going to talk about behavioral and mental health, as well as also just talking about overall liability issues that businesses may have to be thinking about or should be concerned with. So stay tuned for those. Certainly this evening, we're going to do something fun and shift from maybe the serious side of economics and go to our screen to table. I'm sorry, the screen to table is next week. Tonight is cocktails, mocktails, and carryout. So come with your favorite drink, whether that's alcoholic or non-alcoholic, as well as also be sure to order out from a nearby restaurant, one of your favorites, and share what it is that's so special about that establishment. So again, I thank you all for joining us, and I will see you soon. Be safe.